Well, this is the Life and Money Show, where we provide you the information you need to win with your money. I'm Doug King, your host and on-air financial coach. Thanks for joining us today. We have with us William Dunkelberg, economics professor at Temple University and chief economist for the NFIB, which stands for the National Federation of Independent Business. Professor Dunkelberg is a nationally known authority on small business, entrepreneurship, consumer behavior, and consumer credit and government policy. He has appeared on CNN, CNBC, the ABC, CBS, and NBC evening news programs, and Good Morning America. He is frequently quoted in major news publications and serves on the economic forecasting panels for USA Today, Business Week, and Forbes. So call in with your questions or comments. In fact, we have Kelly in Mechanicsburg waiting to ask Professor Dunkelberg a question. The number is 960-0960. That's 960-0960. Now, if you prefer email, our email address is lifeandmoneyshow@yahoo.com. That's lifeandmoneyshow@yahoo.com. And we're going to get to Professor Dunkelberg in a second. I just want to pay the bills here and talk about one of our key sponsors, John Klingler of Klingler & Associates. John is one of the area's top personal and business accountants. In fact, he is my accountant. Look, folks, you want to make sure you have a good accountant, someone who will keep you updated. We all know that tax laws change all the time. His firm provides accounting and bookkeeping services, income tax preparation, and assistance with small business development. They have a clear vision, and that is to serve you. So call 243-7743. That's 243-7743. Now is a great time to call John. He's conveniently located in Carlisle on Hanover Street. So give him a call today at 243-7743. Don't wait. Start saving on your taxes today. We have with us William Dunkelberg, economics professor at Temple University and chief economist for the National Federation of Independent Business. So if you have a question or comment, the number is 960-0960. That's 960-0960. Professor, welcome to the Life and Money Show.
Well, thank you, and good morning.
Good morning. This is a much better time slot than the last time you were on. You were on with us, about 6 months ago in the middle of winter, about 7 in the morning. So
that's too early.
We greatly appreciate you joining us again and being with us. We actually have a caller on the line, so we just want to get to them right away. Kelly, are you with us?
Hi, Kelly.
Yeah, hi.
Yeah, what's your question for Professor Dunkelberg?
Is the U.S. dollar poised to fall, and how is this going to affect the elderly?
Okay, good question. Well, let's take it in two parts. One is the U.S. dollar poised to fall? The answer is yes, for a lot of reasons, but one of them, of course, is the huge trade deficit that we run, because in order to finance an $800 billion trade deficit, the rest of the world has to be willing to accept $800 billion in some form or another, and we do that every year, and so the world is starting to get kind of flooded with dollars, and dollars are like any commodity. If people want it, its value goes up, and if they have enough and they don't want any more, the value is going to go down a little bit. So we'd expect to see that happening over the next year or two. How is it going to affect the elderly? That's a good question. It depends on what you want to do in life, of course. If you want to travel in your elderly years, why, it's going to be more expensive to go to Europe or other countries because the dollar will buy less services from them and less goods, so you'll pay more for your hotel room and your flight and so on. If you go overseas, it would also mean that imports that you buy would be more expensive, so foreign cars will become more expensive relative to domestic cars. And so how it really affects an elderly person depends on what's in their basket of consumption, what kinds of things you buy. In general, I think it'll probably be good for the country overall, because the dollar has been relatively high for a long time, which means it's been hard for our farmers to sell overseas and hard for our manufacturers to sell overseas. Because our goods, when the dollar is strong, are more expensive to the rest of the world, and so they buy less.
Kelly, do you have a follow-up question or comment for Professor Dunkelberg? No, I think she might have just got off.
Lost her.
Yeah. But anyway, that was a very good question, and if you don't mind, I'd like to follow up with that. Do you think that right now there's an artificial demand for our dollar, given the fact that countries do have to finance our debt?
Well, I don't think there's any artificial demand, and nobody has to finance our debt in the sense that they're not obligated to lend us money unless they want to. Excuse me. But think about this: interest rates in Japan, for example, have been very, very low for a very long time. And if you're an elderly person in Japan saving money, what do you want to do? Lend it to somewhere in Japan at 1% interest, or lend it in the U.S. to the U.S. Treasury, which is totally safe, at 4 or 5% interest. And obviously, you prefer to get 4 or 5% interest on your money. Our interest rates have been higher than the rest of the world. And so people are happy to lend money. It's just as you're happy to put money in a bank that offers you the highest CD rates. When that changes, of course, people may change their inclinations to lend us money.
Well, that's a very good area and very good topic, and we're going to touch on that later. I just wanted to ask you a couple questions about your personal involvement with NFIB. How long have you been the chief economist with them?
Over 30 years.
And what does the National Federation of Independent Business do?
Well, basically, it lobbies in Washington and in the state capitals like Harrisburg on behalf of small business. We look out for small business interests and make sure that large firms don't hold sway with the legislators too much, and pass legislation that hurts small businesses to the benefit of larger ones.
Now, you serve on the economic forecasting panels for USA Today, Business Week, and Forbes. Just exactly what do you guys do on those panels?
Well, we basically make forecasts of the economy from our perspective, and then USA Today, for example, summarizes those forecasts from about 50 economists and puts them into a nice pie chart so you can get, if you read that article when they publish it quarterly, you can get a sense of where we economists think the economy is headed. Inflation, employment growth, GDP growth, all those kinds of things. The value of the dollar, for example. So we forecast those things. They average them. They call it a consensus. It's not a consensus because we don't all agree, but it's an average. And then the averages turn out to be pretty good predictors of how the economy is going in the future.
Professor Dunkelberg, we have another caller on the line. Quince in Mechanicsburg. Welcome to the Life and Money Show. What's your question for Professor Dunkelberg?
Hey.
Hey, Quinn.
In order to build confidence in the dollar, how high should the Fed raise rates?
Well, you're a guy who understands economics. Obviously, the higher our interest rates are here in the United States relative to other countries, the stronger the dollar will be, because if you want to earn our high interest rates, you can't earn them with yen or other currencies. You have to earn them with dollars. So, people sell their currencies to buy dollars, and that makes the dollar strong. So if we raise, as we expect, if the Federal Reserve raises interest rates again next week and we see another quarter point, that will make the dollar a little bit stronger in the short run. But keep in mind that as a matter of formal policy, and I think operationally, we don't try to manage the value of the dollar. The Fed is focused on one thing and one thing only, and that's inflation. And that's important to the value of the dollar for this reason. If you have a dollar in your pocket and you hold it for a year, and we have 5% inflation, it will only buy 95 cents worth of goods at the end of the year. So other people in the world don't like to hold currencies where the inflation rate is high. So if inflation picks up here, that's the thing that will make the dollar weaker, because people say, hey, I'm not holding my resources in dollars anymore. I'll go to euros or yen or pounds or something. So it's really the inflation rate that the Fed focuses on, not the value of the dollar. And other countries have been raising their interest rates too, so they're kind of keeping up with us. So probably not a lot to gain in terms of the value of the dollar there. The real value of the dollar will depend on what it buys, and the way we control that is to keep inflation low.
Well, those are both very good questions, I think, right out of the gate here. And I just want to follow up with, if I may. We're going to get to this later on in the program as well, but I wanted to ask you, Bernanke seems to me in a tough spot right now, because if they do raise rates, that's fine. But if they're going to look at inflation, and we know that core has been rising quite quickly over the past 3 months, if they try to look at stopping inflation by raising interest rates, in a way, that's going to slow economic growth to some degree. I'm not saying a lot, but to some degree, it could possibly slow economic growth. I mean, what's your take on that? Do you find that the Fed is in a tough spot right now, or are they just kind of testing the waters here? What's your feeling on that?
Well, the Fed's always in a tough spot. Because, of course, the Fed has a bunch of economists like the rest of us who aren't at the Fed, and we all look at the same data and try to forecast the future, and it's not easy. So we don't really know what's going on. But it is true that the way the Fed controls inflation is to try to manage what we call aggregate demand. That is total spending by businesses and by consumers. Unfortunately, the most sensitive component of our spending is on houses. And so what usually happens historically is the Fed raises interest rates, mortgage rates go up. That slows the housing market. Employment goes down in the housing market. Fewer guys in construction shop at Walmart. Walmart lays off a few people, and then you just keep going on. You can see it slows the economy down. But that does take the pressure off of prices. Right now, the economy is growing faster than we think its capacity is growing, and that is putting pressure on prices and wages. And so the economy does need to slow. And if it doesn't slow on its own, that is, if you and I don't stop spending all of our money, and we are now spending more than we take in total, if we don't do it, then the Fed will slow us down a little bit so that we don't have inflation and all the bad things that go with it.
Right, because about 3 years ago, the Fed lowered the Fed funds rate to about 1%. Am I correct?
Right.
And so in that regard, it freed up so much liquidity. And for the first time, a lot of people could afford a home because they could finance it. There are a lot of fancy strategies out there, 100% financing and interest-only loans, those types of things. But out in really hot housing markets like out in California, and you could even say in the Philadelphia area, Baltimore, Washington quarter, we saw a number of people going into homes that previously they wouldn't have been able to afford. And as a result, it drove up housing prices. And of course, now we're seeing a decrease in housing starts in general, and the optimism out there with builders is slowing down. So do you feel that the Fed is doing the right thing? They're on the right course, and eventually there won't be a complete drop in the housing market, but it'll be sort of like a soft landing as they're constantly reminding us. What's your take on that?
Right. I don't think the housing market is going to be decimated this time around. Keep in mind that today's 30-year mortgage is still historically very low, and that's because our interest rates are still pretty low. So there's still a good deal out there. There was, with the speculators who got in the housing market, there was a lot of kind of dicey financing, the interest-only stuff, the variable rate mortgages, which qualify people, at very low interest rates. Those are there, and we're going to see some adjustments there. We already are seeing some problems there. But we don't think interest rates are going to go much higher than they are now. If you ask economists, a group of economists like the USA Today panel, where do you think the Fed is going to go? A bunch of them will say, well, they're not going to go any higher than they are now, and certainly 6 would be a top rate that would have virtually all economists inside that band. So we don't really expect to see the Fed do a whole lot more. We think the economy is poised to slow down, slow down enough to give the Fed what it needs, which is a termination of the increase in prices. Remember, inflation is an increase in prices. So if we take, for example, the $3 gas, if it doesn't go to $3.05, it's not inflation. It's still too high. We'd like to see it lower, but at least if it doesn't keep going up, we don't have inflation, and we think we'll be there pretty soon.
Right, and I noticed, Joe, I've got a stat here over the past 3 months, core inflation, that's excluding energy and food, is up to an annual rate of 3.8%. That's the fastest pace in more than a decade. And I know that the Fed likes to see that core number between 1% and 2%, at least that's what I've read. In your opinion, right now, do you think that with an increasing Fed funds rate that they can stem that core rate?
Well, eventually, yeah.
Okay, but just how high do they have to go, I guess, is the question.
Well, again, most of us economists, not that we're the best forecasters in the world, but I guess we're the only ones. Most of us feel that somewhere between where we are now at 5 and the 6% range ought to be more than enough. And everybody basically has forecast a slowdown by the end of the year, and that should certainly take the pressure off of prices. There's no pricing power unless you have very strong spending demand. If people are at your door banging on the window trying to get your stuff, you can raise prices. But if nobody's out there, then of course you can't raise your prices, and that's when inflation turns around, and the taming of inflation comes from a slowing of the growth in demand.
And I know that you are an expert in consumer behavior and credit, and as you know, a lot of folks have been using their homes like ATM machines, taking out equity, and sometimes it's good stuff. They're putting an addition onto their home, or they're building a deck, or even financing their kids' college education, let's face it. But in some cases, folks are taking that equity out and buying stuff. And that buying of stuff has really, I thought, increased our economic demand over the past 2 years. Do you see a slowing down as far as lending and as far as this loosening up of liquidity and free money from lower rates? Do you find that whole area is going to slow down as well?
Yeah, definitely. The consumers had a real ball with a huge increase in prices that built up a lot of equity. Hundreds of billions of dollars have been taken out, and you're right. About a third of that has been put into paying off other debt, which is good because the total amount of debt on your portfolio then doesn't change. You just swap $1 for another. That's a good idea. Another third has been put into the house in additions and repairs, as you commented. Then the other third has kind of been spent on everything else. And certainly we've seen since 1995, the percentage of GDP accounted for by your spending and my spending consumption has risen from about 67% to 71%, which is an all-time high. So the consumer's been on a binge for the last 5, 6, 7 years, no question about it. And it's pretty clear we'll slow down very gradually, but nothing very dramatic. But we do need to start saving. Right now, for the whole economy, our spending exceeds our total income after taxes. And, of course, we've been able to finance that by borrowing money. And now with the stock market not doing quite so well and with house prices flattening out and falling in some markets, we think that that will slow consumption down.
We have with us Professor William Dunkelberg, Chief Economist for the National Federation of Independent Business. We're going to take a break, Professor. When we're coming back, we already have a caller on the line, Ron, and we'll get to him right after the break. Folks, you're listening to the Life and Money Show. It's 1040. 960 WHYL. Doug Keegan here, wrapping up the Life and Money Show, where we provide you with the information you need to win with your money. Coming up next is the Corky Goldstein Show from 11 to 12, so stay tuned for Corky right here, only on 960 WHYL. We're talking with William Dunkelberg, economics professor at Temple University and chief economist for the National Federation of Independent Business. Professor Dunkelberg has appeared on CNN, CNBC, the ABC, CBS, and NBC evening news programs, and Good Morning America. So please call in with your questions or comments. The number is 960-0960. That's 960-0960. And we have Ron on the line. We're going to get to him in a second. I just have to first pay the bills. Is your business drowning in health insurance costs? If you are a small business owner, do I even need to ask that question? We all know the rising costs of healthcare now compete with the cost of payroll for many small employers. So if you are a small business owner, you need to call Benefit Connections today. What they're going to do is they're going to look at all of your insurance programs that you currently have in place. They're going to reveal their strengths and weaknesses, provide an easy-to-read summary, discuss creative options such as health savings accounts, and explain how alternative funding options can help you manage your money. So call Benefit Connections today at 258-5599. Mention the show, and they will waive the evaluation fee. So for health, dental, vision, life, and disability, call Benefit Connections today at 258-5599 or on the web at creativehealthinsurance.com. And we have with us William Dunkelberg, economics professor at Temple University and chief economist for the National Federation of Independent Business. And let's go right to the lines. Ron in Carlisle, are you with us? How are you doing today?
Good. How about yourself?
Great. Thanks for joining us. What's your question for Professor Dunkelberg?
Well, I had two questions. One, I wanted to know, the Federal Reserve back in March stopped reporting the M3 number. And I was kind of curious as to what reason they gave for stopping to report that.
Well, taking the first question, I can handle it real quickly. I don't know. I have not paid attention to the monetary aggregates. In the old days, when checking accounts were just used to hold money to buy things and paid no interest, so otherwise, if you weren't going to use the money, you put it into a savings account somewhere. And to get the money so you could use it in a checking account, you had to go down to the bank. How old are you, Ron?
46.
Yeah, see, you don't even remember this probably. You had to take your passbook down to the bank and put it in some clunky machine. It was really hard to move that money from a savings account into a checking account, which is transactions money. And transactions money, the checking account, that's M1, which is defined as checking accounts plus currency in circulation. And in those days, it was like 80% of our money supply was in checking accounts, not cash in our pockets, which is very nice. But with all the financial innovation we've had now, even checking accounts pay interest. And, of course, that's when we invented M2 and then M3, which are just different measures of liquidity. But now, you see, I can, just on the Internet right now, I can move money from my savings account into my checking account. And so what happened is these measures became less useful as a measure of how much money consumers and businesses had in their transactions accounts ready to spend. And so the relationship between that and the measures of inflation that we like to look at and nominal GDP deteriorated, and so we just don't pay attention to those numbers much anymore.
Ron, do you have a follow-up question or a comment?
My other question was, if we're heading into a time of higher inflation, or there's a concern about the higher inflation, and we're already running fairly large budget deficits at the federal level, and I know a lot of the federal programs have built-in cost of living increases based on inflation. Any idea of what the impact of higher inflation would be on the federal budget deficit?
Well, that's a good question, and I'm not really sure. Obviously, you're right. It's going to increase the amount of spending since programs like Social Security are indeed indexed to the headline consumer price index inflation rate. Excuse me, and that's been running around 5% lately, so it's pretty high. That means our retired people are going to get a good raise at the end of the year unless something very dramatic happens, which, by the way, could. All of that increase in the price level so far this year could easily be wiped out by a decline in energy prices in the second half of the year. So we'll have to wait and see what happens. It adds a lot of money. You can kind of think of Social Security as being a couple of $100 billion a year, and if it goes up by 5%, you can do the math and see how much more the government will have to spend in order to
over the next
whether it adds to the deficit or not depends on tax revenue.
Really get a lot worse. All right. Well, I appreciate the insights there.
Okay, Ron. Well, thanks for calling the Life and Money Show. We appreciate it.
Yeah, no problem. Yeah, we'll talk to you later.
Okay, bye-bye.
Bye-bye.
Hey, Professor, we did a little skit here. Now, this was something that was done on Saturday Night Live not too long ago. And since you're an expert in consumer behavior and credit, I thought I'd play it for you today, and then we can segue into some other issues I want to talk about. Scott, can you tee it up for us?
I just can't get these numbers to add up.
Like we're never going to get out of this hole.
Credit card debt doesn't ever end.
Maybe I can help.
We sure could use it.
We've tried debt consolidation companies.
We've even taken out loans to help make payments.
Well, you're not the only ones. Do you know that millions of Americans live with debt they cannot control? That's why I've developed this unique program for managing your debt. It's called Don't Buy Stuff You Cannot Afford.
Let me see that. If you don't have any money, you should not buy anything. Sounds interesting.
Sounds confusing.
I don't know, honey. This makes a lot of sense. There's a whole section here on how to buy expensive things using money you save.
Give me that. And where would you get to save money?
I'll tell you where and how in Chapter 3.
Okay, so what if I want something, but I don't have any money?
You don't buy it.
Well, let's say I don't have enough money to buy something. Should I buy it anyway?
No.
Now I'm really confused.
It's a little confusing at first. It's in the book. It's only 1 page long. The advice is priceless, and the book is free.
Well, I like the sound of that.
Yeah, we can put it on our credit card.
So get out of debt now. Write for your free copy of Don't Buy Stuff You Can't Afford. If you buy now, you'll also receive Seriously. If you don't have the money, don't buy it. Along with a 12-month subscription to Stop Buying Stuff magazine. So order today.
Professor Dunkelberg, we put that together, and we had that on a couple weeks ago just for fun. But I just wanted to bring that up because I know that a lot of folks are maxed out on their debt. What effect will that have on our economy, or does it even matter anymore with such all these different financial instruments that we have available to us?
Well, first of all, the skit is the best advice ever. Don't treat your credit card any other way than as money. The great advantage of credit is simply this. It allows you to enjoy the services of a car or a house early on without having to save until you have enough money to get them. But either way, you're making monthly payments. For example, if I want to buy a $10,000 car, if I want to pay cash, I've got to save money every month, make a monthly payment to a savings account until I have $10,000 and I can buy it. Or I can borrow the money and get the car now and then make monthly payments to the bank who lent me the money. But either way, you have to view yourself as having to pay the $10,000. In one case, of course, you are earning a little bit of interest on the money. In the other case, you're paying interest to some other person who put their money in the bank and lent it to you. But it's kind of the same deal. But that's the discipline, is you can't buy things that you can't afford, so your income has to be the overall determinant of what it is you can buy. Now, that discipline is really hard. It's really easy to whip out the plastic, as we all know, and buy things. And the Fed studies this whole issue about over-indebtedness, and they just released their most recent report a while ago. And the interesting thing is that the annual debt payment as a percentage of income for the economy, for the lowest 20% of the income distribution and the highest 20% of the income distribution, has hardly changed since 1990. It has grown just a little bit, a couple of percentage points. So say we've gone from 15% of our income to the annual debt payments up to about 17%. So there has been a huge explosion in credit in dollar terms, but remember, we've had a huge explosion in our incomes and our wealth in dollar terms as well. So relative to our ability to pay, we're still in pretty good shape.
I think that's great advice, Professor. And moving on to a very hot topic right now. We only have 3 minutes left. And by the way, we're talking with William Dunkelberg, economics professor at Temple University and chief economist for the National Federation of Independent Business. Professor, the U.S. Senate defeated a proposal pushed by Democrats this past week to raise the federal minimum wage in increments from $5.15 to $7.25 by January of 2009. Now, right here in Pennsylvania, there's a bill to raise the minimum wage from $5.15 an hour to $7.15 an hour, and it passed the House and is currently in the Senate Labor and Industry Committee waiting for approval to call a vote. On the one side, you've got folks calling this a fair wage proposal. On the other side, people are saying it'll just hurt the people it's purported to help. Can you explain the debate for us?
Sure. Okay, well, of course, let's first of all note that raising the minimum from $5.15 to $7.15 is a 40% increase in the cost of unskilled labor. That's huge. There's a law in economics called the law of demand, and it says simply, if you raise the price of anything, people will take less of it. That would include labor, obviously, which is 80% of the cost of doing business for small business people. So that's a really big increase. Now, let's get down to some other little numbers. What's the goal of this policy? Is it to help poor people? Well, if it is, keep in mind most poor people, by census definition, don't even have a job. And of course, if you raise the minimum wage, you're going to make it harder for people years to come to get a job, because if labor is much more expensive, then it's going to be tougher to get hired if you're an unskilled worker. So that's not particularly a good idea. Another fact to keep in mind is most people who earn the minimum wage are from above median income families. They are not poor people and not the targets of our welfare programs or our help and assistance programs. So what you basically do by raising the minimum wage is you raise the cost of the business, the little pizza parlor model of the economy, for example. So if I'm in a pizza parlor model, I have 10 kids from college working at minimum wage, and I have to raise the cost, I have to pass that on to the consumer in the form of higher prices, and that's basically a sneaky way to tax customers to pay for this higher minimum wage. But I also won't hire quite as many. I won't hire 10, I'll hire 9 instead, and that's basically how that plays out. So it's not a very good way to help people, as we allege that it is. Much better is the Earned Income Tax Credit, which says get a job. If you don't earn the money we think you need, as a family of 4 or a family of 1, we'll send you a check instead of you sending us a tax check. That works a lot better.
Well, thanks for that. I mean, I know this debate is hotly going on right now in this state and as well at the federal level, so thanks for some clarity there. Well, we're going to have to wrap up the show, but I want to thank you for coming on again. We've been talking with William Dunkelberg, economics professor at Temple University and chief economist for the National Federation of Independent Business. Thanks again, Professor.
My pleasure.
Well, tune in next week, folks, to hear Rob Cole, president and owner of Benefit Connections, to go over what you need to know about your healthcare plan at work and how you can get better protection for you and your family. Well, you've been listening to the Life and Money Show, and I hope today's show has been informative. I think Professor Dunkelberg is extremely well regarded in the economics community, and I hope you enjoyed our show today. Now, I'm Doug Keegan, your host, and I want to sincerely thank all of you out there for tuning in. Without you, we would not be here. We greatly appreciate it. Don't forget to stay tuned for Corky coming up next. And remember, the best investment you can make is ironically not in the stock market, but it is in the betterment of yourself, your family, your community, and ultimately the world. It's 10:57.